Spain, 2006. The country's economy was booming. Over the past 6 years, per capita production had doubled. German economists were confident that within 5 years, Spain would surpass Germany in income levels and become one of Europe's key players. In some regions, unemployment had nearly vanished, and the government created favorable conditions for work. The entire country was optimistic that this growth would continue. Membership in the Eurozone enabled foreign investment in Spain, particularly in real estate. People bought beachfront homes or apartments in major cities, not just to contribute to the economy, but to enjoy the sunny lifestyle. Real estate agents were recognizable on the streets, and construction companies thrived. Even blue-collar workers like plumbers could afford luxury cars. It was a self-sustaining cycle. Investments in real estate fueled economic growth, making the country even more attractive to investors. But this growth was an illusion. It was fueled by rising debt. When the global financial crisis and the Eurozone crisis hit, the debt bubble burst. Nearly 2 decades later, Spain's economy still hasn't fully recovered. Unemployment remains high, especially among young people. Economic growth is stagnant, and paradoxically, real estate prices are still unaffordable for most people. Spain became a cautionary tale of how over-reliance on debt can derail even the most promising plans. Yet many experts argue that Spain's economy at the time was less vulnerable to risks than some major economies today. This raises a critical question. Has the world truly learned from Spain's crisis? What fueled its rapid growth? Why did it collapse? And why has the country struggled to recover? Are other nations now at risk of facing a similar crisis? Spain's economic story is one of booms and busts. The country has experienced it all, from its colonial empire to post-World War II recovery plans. However, to understand what happened in the early 2000s, we need to go back to the 1990s when the groundwork for its rise was laid. Back then, Spain grappled with persistently high unemployment. In 1986, it joined the European Economic Community, EEC. At the time, its economy lagged behind, with GDP per capita at just 73% of the EEC average. However, in the 1990s, after a global recession, the government managed to curb inflation and increase public spending, which helped bring down unemployment. By the mid-1990s, the economic outlook began to improve. In 1999, Spain was among the first countries to adopt the euro. Like any major political decision, this had its pros and cons. When a country maintains its currency, it can independently manage it, devalue it if needed, and control interest rates. By adopting the euro, Spain gave up this control. Now Spain depended on the broader policies of the Eurozone, which reduced its flexibility in managing its economy, particularly during times of crisis. Thus, the Spanish economic crisis can be seen as a consequence of losing control over key economic management tools. Spain experienced a unique economic boom before the crisis, largely driven by its integration into the Eurozone. The introduction of the single currency, the euro, made trade with neighboring countries much simpler, facilitated price comparisons, and allowed businesses and consumers to find the best deals. One of the most significant advantages was that the euro proved far more stable than Spain's previous currency, the peseta, which had struggled with volatility. With a vast network of countries using the euro, maintaining its relevance in international trade became significantly easier, and credit became more accessible. These low-cost loans became the driving force behind the country's economic growth. What initially appeared to be a blessing, however, also had a darker side. On paper, Spain's economy began growing so rapidly that many viewed it as a potential new powerhouse in the Eurozone. Economists trace the start of this boom to 1998, 1 year before the euro's introduction. At that time, Spain experienced a surge in immigration, which authorities saw as an opportunity for further growth. With a growing population came an increased demand for housing, leading to a rapid expansion of the construction industry. For the government, this seemed like a winning strategy. Construction created jobs, which was especially vital for a country with a long history of high unemployment. During this period, workers who previously could not afford even a basic car were suddenly driving luxury vehicles, thanks to the high demand for their labor. The main driver of this boom was the availability of cheap loans offered at low interest rates. This became possible due to the euro, which minimized currency fluctuation risks, and Spanish banks took full advantage of this to issue credit. Real estate quickly became the primary investment focus, fueling an unprecedented construction frenzy. Another critical factor was the Spanish government's generous tax incentives in the real estate sector, which attracted both domestic and foreign investors. Unlike many other countries, Spain did not tax rental income, capital gains, mortgage interest payments, or even allowed the deduction of principal mortgage payments from personal income taxes. These measures made the country exceptionally appealing for investments, further accelerating borrowing in the real estate sector. But why didn't Spain's central government recognize the looming disaster? Why didn't international investors see the risks associated with the rising debt? Looking back, it's clear that many economic indicators at the time pointed to trouble ahead. However, few paid attention to these warning signs. Similar to the case of Bernie Madoff, hailed as a financial genius before being exposed as a fraud, many should have exercised more caution. One factor that concealed the true state of affairs was the unique structure of Spain's economy and its fiscal decentralization. Spain is one of the few countries where the central government plays a minimal role in borrowing decisions. Much of this responsibility rests with autonomous regions, which manage their own budgets. The country consists of 17 autonomous regions, including the Canary and Balearic Islands, as well as 2 autonomous cities in Africa. These regions were responsible for collecting taxes and funding healthcare and education, which significantly obscured the nation's overall debt picture. At the same time, Spain had about 45 regional savings banks, known as cajas, which were heavily invested in real estate. This fragmentation in financial reporting allowed Spain to present positive economic figures, while the underlying reality was far more precarious. When Spain joined the EU, many legal barriers to foreign investment were removed. This opened the floodgates for capital from countries like Germany, the UK, and France, further fueling the construction boom. The influx of funds spurred job creation, with Spain alone accounting for more than half of all new jobs in the EU. Construction became the engine of the economy, and housing prices skyrocketed by 70% between 2003 and 2008. However, this rapid growth was built on a fragile foundation. While Spain anticipated some risks and created a reserve fund to cover potential loan defaults, the 35 billion euros set aside proved far too small to handle the looming crisis. Ultimately, the country couldn't avoid collapse. So, what was the key cause of the crash? Immigration had a significant impact on the surge in housing construction and was one of the reasons many people urgently took jobs on building projects. However, Spain made a critical miscalculation in its estimates of how many homes were actually needed. This was a major oversight. By 2006, more than 800,000 homes had been built in Spain, while only 200,000 families moved in. Amid the chaos of this construction boom, some market players didn't even try to manipulate laws in their favor. They simply resorted to outright deception. A study by professors José María Rey and José García Montalvo examined the structure of Spain's mortgage system to understand how housing prices were determined. They focused on the loan-to-value (LTV) ratio, which indicates the percentage of a home's value covered by a mortgage. On the surface, it seems straightforward, but this is where the problems began. The Bank of Spain deemed mortgages with an LTV of less than 80% safe, as it implied that 20% of the home's value was already paid up front. However, the closer the LTV approached 100%, the higher the risk and the greater the likelihood of default. Rey and Montalvo uncovered a startling practice. Banks had found ways to issue loans while bypassing these regulations. They did so cleverly. If bank staff noticed that an LTV was nearing 100%, they would contact an appraisal company and request a lower valuation for the home, which automatically reduced the LTV ratio. According to the researchers, appraisal companies would artificially inflate home values so that banks could approve loans, buyers could purchase homes, and banks could technically remain within regulatory boundaries. This was one of the riskiest practices Spanish banks engaged in, either unaware of or willfully ignoring the potential consequences. As a result, homes became grossly overvalued, leading to disaster when borrowers were unable to repay their mortgages. These inflated real estate prices, supported by appraisers and banks, seemed like a great deal for many Spanish homeowners, until the bubble burst. When the market collapsed, debt in Spain's real estate sector reached nearly 50% of the country's GDP. Thousands of families were unable to repay their debts, and property values plummeted. Banks couldn't absorb the losses because the homes were worth far less than their purchase prices. The once abundant credit that had fueled the boom dried up overnight. Construction companies, which had thrived on speculation, were left drowning in massive debt. The €35 billion reserve fund, set aside for such a crisis, was a drop in the ocean and provided little relief. This situation seems astonishing, but many countries today face even greater risks. For instance, as of March 2023, Australia had a household debt-to-GDP ratio higher than Spain's pre-crisis level, 116% of its nominal GDP compared to Spain's historical peak of 85%. Australia's debt-to-income ratio has risen significantly since the 1980s, reaching one of the highest levels among developed countries by 2018. Similar trends are evident in other nations. Favorable tax policies for real estate investors, banks turning a blind eye to rule-breaking for profit, migration, speculation, and the belief that beachfront homes should cost 15 times the average annual income. Take Canada, for instance. By the end of 2023, Canada's household debt had reached 104% of its GDP, higher than Spain's on the eve of its financial crisis. These countries are rife with stories of construction workers earning more than their professional peers, and real estate agents becoming television celebrities. The housing price boom Spain experienced in the early 2000s now pales in comparison to the surging real estate prices in these countries over the past 5 years. One would hope Spain's story ended on a positive note, but it didn't. The country is still grappling with the aftermath of that crisis nearly 2 decades later. Spain followed the playbook often used by nations trying to revive their economies. When in doubt, spend money. And Spain spent a lot. It allocated more funds for stimulus measures relative to GDP than any other European country. This crisis would likely still dominate headlines if another country hadn't shifted the focus to its own troubles: Greece. In 2009, Greece's new government revealed that its budget deficit was higher than previously disclosed. This revelation led to a loss of confidence in the Greek economy and overshadowed Spain's struggles. However, this shift in global attention didn't solve Spain's problems. Even as the world focused on Greece, Spaniards felt the impact of the crisis. Spain still faces significant economic challenges. While most Western nations endured a downturn in 2008, Spain was hit particularly hard. In the years since, there has been modest growth, but the GDP has yet to recover to its 2007 level. Back in the 1990s, Spanish wages were comparable to those in France and Germany. Today, the average annual salary in Spain is just €29,000, 10% lower than before the crisis. With rising debt and inflation, life for ordinary Spaniards is worse than it was 20 years ago. To address the financial fallout and save its banking system, Spain was forced to reform nearly all its savings banks, making access to credit more difficult even today. Furthermore, membership in the Eurozone, once seen as a path to stability, has prevented Spain from pursuing flexible monetary policies, exacerbating its challenges. As a result, many skilled professionals have left the country, creating yet another obstacle for a nation in desperate need of talented and capable workers. The days when workers could afford sports cars are long gone. Spain's unemployment rate remains higher than that of most European countries, and while 2024 shows signs of economic growth, in reality, many people are relying on temporary gigs with no long-term stability. It may be too late for Spain, but other countries still have a chance to avoid the same fate. Spain should serve as an economic cautionary tale. No nation can rely on a single sector to solve its financial problems. Spain is a warning, a reminder that gambling with an economy can lead to disaster. If it happened in Spain, it can happen anywhere. Share your thoughts in the comments, subscribe to the channel, and thanks for watching.